compliance, litigation, regulatory, there are certain risk classes that have come to the fore over the last few years, and that journey has really been through our experience and some of the prices we've paid in the financial services sector: conduct risk, cybersecurity, and stress testing. I would put stress testing in a class of risk and really call it stress testing risk. Cybersecurity has heightened management, board, and regulatory attention. Over time, the speed, sophistication, and severity with which cyber attacks are launched has really increased. Investments by the financial services and the banking sector within it to protect themselves from cybercrime are going to have to keep pace. I think in all this, the good news is that a significant proportion of these attacks can really be prevented through a strong control environment. That said, protecting against internal and external data isn't exactly an easy task. We need to know what all sensitive data we've really created, where is it stored, how is it being used, who has access to it within our system, and how is it moving in and out of our organizations. The story of the hackers at Target is quite instructive. Hackers broke into Target through a vendor of Target. Once inside, they were able to procure credit and debit card details at the tills before the data could be encrypted. 40 million records stolen, the CEO stepped down. Conduct risk has topped the agenda of regulators and banks in recent months. UK has led the way. Senior manager regimes have ignited debates around personal accountability and the importance of management information to effectively carry out those responsibilities. Financial services businesses are really built on trust. Our prosperity is linked to the prosperity of our customers. Yet there have been instances where firms have gained at the expense of their customers, such as payment protection insurance, LIBOR fixing in the US and UK. And following these were events that were uncovered in Asia Pacific around misconduct, excessive fees for dormant accounts, manipulation of LIBOR and other benchmark rates, mis-selling of investment products, excessive credit card late fees. I think the point being that the nature of the financial services industry globally is quite similar. So the problems that happen in one part of the world, the other part of the world is not immune to it just because they haven't immediately encountered it or uncovered it. The dial on conduct risk is moving toward an expectation that banks must do the right thing by the customer rather than simply comply with regulations. Conduct risk appetite, frameworks, and the guidance around what really makes for an effective management information, that will be evolving, and a space that we will all be watching and participating in very closely. And the topic of today, which is an extremely important topic because it's like contingency planning, health check, it's for the rainy day. It's like we plan for all the problems we ever think about, our retirement, and it's no different than the reality of life. If you haven't planned for the bad day, you're really not planned for being in the business. Stress testing has evolved from being a crisis management to a supervisory tool. Regulators are interested in the quality of internal controls, in the strength of the board of directors. It's not just about making future assumptions and projections around P&L and capital. It's also about solidly defensible justifications underlying these assumptions. Stress testing regimes vary across the US, Europe, UK, and Asia, and in part they're influenced by the degree of impact during the GFC. In the US, the Fed has its own stress testing model. It prefers that banks do their own comprehensive testing. They basically do not want banks to construct their portfolios in response to the Fed model. That sounds familiar, I suppose, to the financial service industry. Notwithstanding the impatience by shareholders, the banks have responded to stress testing by reducing riskier assets. Some of this MJ just touched upon, infusing capital, reducing dividends and capital payouts. Failing the stress test has costs associated with it, possibly higher. Reputational, impact on market cap, downward rating pressures, and increasing cost of raising capital, to name a few. One of the European banks whose US unit failed the Fed stress test in 2014, the global compliance and regulatory costs increased by upwards of 700 million, and I know this from public information. Directionally consistent with what's going on in the US, the Bank of England has followed suit in its own way, I suppose, publish its own approach to stress testing. BOE wants to further develop its own modeling capabilities. They're talking about a comprehensive approach, deeper analysis, flexibility in responding to changing risks, and importantly, counter-cyclical stress testing, scenarios with greater severity during an upswing. And that's really important because you can only create buffers during the good days. Supervisory stress testing in Europe has evolved too. We know that Bankia and Dexia made and basically passed the 2011 stress tests, but needed to be rescued. More recently, supervisors in Europe are focusing on asset quality. 2014 European Central Bank comprehensive assessment included asset quality review. Asia did not suffer much from the GFC. It's good, but we don't want to make it bad, right? Abundance of liquidity fueled by quantitative easing, long-term low rates in developed economies that have supported asset prices. They've supported growth and credit expansion. Of course, Asia has had its own strength that contributed to it as well. In such an environment, what doesn't easily come to the fore is riskier assets, is weak lending decisions. Paucity of accuracy and data around portfolio quality makes it even harder to identify risks. Unlike the US and Europe that invested in their stress testing capabilities post severe difficulties faced as a result of the GFC, Asia could really take advantage and move ahead of its problems. So it's a currently relatively benign environment that we face into, and it puts us in a very good position to take advantage of that situation and prepare for the next potential downturn. And as we know, most of the time when we bought insurance, we don't end up using it. But we don't have it, we most need it in the future. Asia stress testing should, of course, be aligned with Asia's own priorities, basically its own vulnerabilities, presented by some of the aspects that we see. Dependency on China growth, commodity prices, asset valuations, including real estate valuations, dependency on the wall of liquidity that we benefited from, foreign exchange movements et al. Different jurisdictions and different regulators would have their own objectives and planning processes, which will dictate the evolution of their stress testing regimes. I think there's much more to be said in the sessions to be followed on stress testing. But before I leave the mic, I do want to share 4 key themes that I brought with me today to talk to you about. 1, it is important to focus on, and these are basic risk management, which we don't want to check out on, because end of the day, it's all about managing our risks holistically. And stress testing feeds into that, making us more robust. So it's important to focus on right resourcing and talent. In the current environment, with so many competing priorities, it may be tempting to manage with tighter and less experienced resources. That could be a recipe for self-propelling downward spiral, which we want to avoid. 2, keeping a keen eye on the core fabric of our business, and importantly, the way we go about doing our businesses. Time and again, banks have gotten into trouble because of weak credit quality. While we focus on strengthening our control environment, we cannot afford these efforts, which are actually meant to make us more robust, to become the very distraction that costs us our asset quality. Watching out for evolving business themes and concentrations in our credit portfolio is absolutely essential. And stress testing is quite helpful in making sure that we follow the right disciplines in terms of the quality of our assets, of our credit that we have. 3, protect ourselves from our own inherent human nature. I think that's the biggest risk banking has always faced, time and again, and memories are always short. When things are going well, we believe that will continue to be the case. Again, I think it feeds well into the topic of stress testing. It usually starts with that first small bet, soon growing into a sizable, profitable business. We've seen that before. Profitable business internally in organizations require a disproportionate amount of courage to challenge them, especially if they've attained critical mass. Winning organizations promote a culture that allows for healthy debate and escalation around such situations. And I think stress testing regimes can help those in the organizations who want to do the right thing or bring such situations to the fore, because you're armed by the will of the regulator to make you do certain things, so it becomes a reasonably good excuse to do the right thing. And lastly, we ourselves are best equipped to know our vulnerabilities. Passing an internal or external regulatory exam or stress test is necessary, but not really sufficient for our continued strength and sustainability. Our customers and our economies that we operate in need us. We serve a very important purpose for the societies and communities. Those of us who manage our risks well and focus on being strong will be the long-term survivors and will be eventually rewarded. With that, I'd like to thank you again for your time and your attention.
Thank you, Anju. Am I audible? Am I audible? Okay. Thanks, Anju. Anju started with a very important topic, that in risk management, conduct matters. Those of us who have watched the movie Wall Street know greed is not good because it leads to jail. Second very important thing Anju has mentioned is capability matters. Whether it's to manage your data through beefing up cybersecurity, or to create models that can predict scenarios, that can tell, and your capital can be conserved. And very important thing, which is we know our vulnerabilities, and we can prepare only when the times are good. When times are good, not good, then preparation, it's too late, and Lehman Brothers can repeat itself. So with that, Thank you, Anju. It was wonderful to hear from you to talk about risk as such. And then we shall continue with our topic of stress management. Before we go on stress testing beyond the headlines, what I'd like to share with you is that, that there is a context which is comprehensive capital analysis and review, which sets stress testing in its path. We'll talk about the process of stress testing. We'll also talk about some of the things that are done to improve the stress test, and finally we shall talk about the results and recapitalization requirements from stress testing. All right, so stress testing itself fits in within the framework of enterprise risk management, and as it's Anju's already stated, the enterprise risk management needs to set the right policies, needs to take care of the monitoring function, needs to manage the collateral, and it goes across the business lines, whether it's the capital book, whether it's the retail or wholesale banking book, whether it's the marketing services, operations, and definitely IT. So that's the enterprise risk management framework. Within that, stress testing fits well. So it starts from the board. The ERM, the enterprise risk management, starts at the board level. The board needs to set the right guidelines to ensure the risk profiles are set appropriately. Board also needs to make sure that the compliance is happening on a regular basis and take actions where there are deficits in the risk management practice. The next very important aspect of ERM is the finance and treasury. If you cannot manage your own home, you cannot manage your own capital, you cannot manage your treasury, the risk management fails entirely. So this is very important to manage the risk associated with your treasury. And again, as Anju said, cybersecurity is very important because lots of our money are in information systems. They are in bits and bytes. So again, the finance and treasury management have to take care of that very earnestly, very deliberately on a regular basis. Then the function of the finance and treasury is definitely to report risk-adjusted performance management or performance. So there have been a lot of debate in the industry, whether it's RAROC, risk-adjusted return on capital, or RORAC, return on risk-adjusted capital. So whatever it is, whatever are the right performance metrics that make sense. However, we have to make sure that the right metric is provided to the public, to the shareholders, to the board, to the executives who are looking at the bank on a regular basis. And finally, the stress test fits in within the ERM, and that's when Anju started talking about that. The enterprise risk management definitely sets the methodology, whether it's modeling or measurements, then has a portfolio level risk assessment, and then takes care of stress testing itself. So that's the right context. We spoke about what stress testing is, how it fits in within the ERM framework. Actual chief risk officer spoke about this. So let's look into the details of stress testing. So what it is it's also called as the comprehensive CCAR, or comprehensive capital analysis and review. The most important aspect of stress testing is it's scenario based. So think about a scenario in which capital might be stressed. What is that event that can happen? It doesn't have to be just something that has happened in the past. It could be an extreme scenario. As one of the speakers here will talk about the black swan theory. Very difficult to predict. Very difficult to talk about a scenario that has never taken place before. But the events that have taken before can be a good guide. So the scenario, whether it's hypothetical or it's historical, plays an important test in formulating the stress management. It's very quantitative. It uses advanced analytics. It uses advanced statistical methods. It goes into the second derivative equations. It goes into Bernoulli's equations, entropic regression. So the model itself, the creation of the model is not difficult, but when you start regressing it against many variables that have a probability, that are categorical, then the model gets extremely complex. So it's quantitative, and it needs to be both modeled right, it needs to be validated and then interpreted. So the quantitative side to it does require a few geeks like me to create it and to analyze it and then to interpret it. And finally, there is a correlation aspect to stress testing, and that means we live in a connected world. Banks are connected to corporations, corporations are connected to consumers, consumers are connected to banks again, and banks are connected to other banks, etc. So stress testing by itself is to be done within a financial institution, but also across the cross section of it. That actually determines the probability of default, the probability that there could be a contagion risk in the system. So that's what stress testing is. Let's talk about what are the different steps that I've observed. These are the tests. Different supervisors give different guidelines on the process, but at a high level, for this large an audience, this is at a macro level the steps that can be undertaken to conduct a stress test. There could be many different variants of it, but we are sticking to this discussion so that at a macro we can speak about what stress testing can be. The first thing is to define the scenarios. We got to be able to create some shock parameters and also select a methodology with which we'll conduct our stress test. The second thing is define what are our major exposures. As a financial institutions, we have our own, as Anju stated, we got to know ourselves. We have to know our exposures, we have to know our vulnerabilities. So we ought to be able to select our exposures with clarity. From here, what we do is we have to define the coverage, and we'll come into the coverage and the details of these steps in a minute. But once all these things are determined, then the data has to be identified and sourced. Many a times the data sourcing itself is a complex problem because the data doesn't reside within one information repository. So it needs to be collected, collated, cleansed, and modeled so that it makes sense, and you can perform quantitative techniques so that it makes sense for stress testing output. Finally, the stress testing is implemented. After its implementation itself, once you are conducting these tests, there are different variables. Some are macro variables, but then how do those macro variables connect to the bank's balance sheet, bank's profit and loss statements? So that process needs to be conducted. We'll go through that, and then the results are obtained. The results of stress testing, the first thing that needs to be is validated. So the banks have their own data. It needs to be benchmarked against that data. It needs to be benchmarked against the data that's available with the supervisor. It needs to be benchmarked with the peer banking institutions. Why that is of importance is because these tests are very complicated, and they're prone to errors. And before any testing results are disclosed, those errors need to be rectified. And finally, the result needs to be interpreted so that the stress testing something can be done about it. So these are the important steps. Sorry. So let's talk about the identification of shock parameters. As we spoke about, there are two different ways of selecting. You can either talk about the historical scenarios or you can create hypothetical scenarios. And the historical scenarios could be very interesting, such as the 1997 Asian crisis, the currency crisis that took place. It could be the 2001 dot-com bust. It could be the Lehman Brothers failure. It could be the hypothetical scenario of S&P dropping 20%. It could be also the macro factors. What if the GDP falls by 20%? What if the unemployment or the industrial production falls dramatically? Again, the idea here is to be not directionally correct, but to stress the system with extremes, and the value that you get is you have to be able to determine the resilience of the system. In the stress, in the shock parameters, what happens to your loan portfolio? What happens to your equity investments? Are there any off-balance sheet items that may cause stress to your balance sheet? Are there other level 3 assets whose valuations change dramatically? So this is why the identification of shock parameters is important. Given a bank's own portfolio, it's important to determine what's relevant to that bank. However, I would highly urge the bankers to not look at their own portfolio in the hypothetical scenario, because economy does impact financial institutions more than any other corporation. The second important thing is to select